Okay, we're going to try something a little different today. One of the questions that was raised in the last lecture had to do with, the practical use of the sort of volatility models that Bullerslev was talking about. And what I thought I would do is to bring in one of the webcast students. And he's on the speakerphone right now, and I'm going to turn it on. Ken, are you there?
Yes, I am. Can you guys hear me?
Yeah, I think so. If we're real quiet, I'm going to turn the volume up a little bit. I was just saying to the class that I thought that you were particularly well suited to answer one of the questions in the class that had to do with the practicality of using GARCH-like models in asset management. This is Ken Kroner, and he's at Barclays Global Investors, and I guess it's early in the morning there, San Francisco time. So Ken, could you maybe address that question to the class here and the other students watching?
Sure, I'd be glad to. I actually found that question fascinating. I know somebody asked on Monday, somebody asked Professor Bullerslev if this GARCH stuff is used in the real world, and I dropped everything I was doing because I was especially interested in hearing what he had to say, because I know that he had just come from our firm where he had spent a full day with us talking to us about the latest developments in GARCH modeling. The answer, as Professor Bullerslev knows, and he relayed to you guys, is that, yeah, absolutely, it's used in asset management around the globe and also in derivatives pricing. And in fact, at BGI here, we manage about $65 billion in global tactical asset allocation strategies, and every penny of that is used, or every penny of that is managed with GARCH-type models, exploiting the kinds of insights that Professors Bullerslev and Harvey were talking about on Monday.
So, do you use, like we had this discussion of like the horizon of actually estimating these models. So, when are you running like high frequency GARCH or low frequency, and how do you deal with that question that we had in terms of the horizon of measuring the volatility?
That's the thing that I've always emphasized to people who are using GARCH models and looking at GARCH models is that the right GARCH model depends on the application, and it's just like the right ordinary least squares model depends on the application as well. No different with GARCH models. Some of the strategies that we run at BGI are what I would call longer horizon strategies, or let's rephrase that, I think, as saying that the holding period is typically longer. We trade less frequently. Some of the strategies are much more of a faster, shorter horizon, or stated differently, the holding period of our positions is much shorter. Well, if you think about it in terms of the holding period, then it becomes pretty clear whether you should be using the high frequency data or the low frequency data in your GARCH modeling. Because if your holding period is going to be 2 days, then what you want is the right measure of volatility and correlations over the next 2 days. And you're never going to get that if you're using monthly data or weekly data in your volatility modeling. You have to be using the high frequency data to get a good measure of volatility and correlations over the next 2 days. But on the reverse side, if your holding period is going to be, say, 3 months, then you don't really need the tick-by-tick, the high-frequency data to get an appropriate measure of volatility and correlations over the next 3-month period. So we use both. It just depends on the application.
Yeah, again, just on that last point, it seemed like what Tim was saying was that he preferred to use kind of the high-frequency data, even if you were doing like a 3-month horizon. So aggregate that up to 3 months. And what I'm hearing you say is that it's pretty likely that you'd be using kind of a lower frequency approach for the sort of kind of like low frequency tactical asset allocation. Is that correct, or is it a mixed bag depending upon the particular asset class you're looking at?
That is correct. We use lower frequency data for the longer holding period. However, I should also emphasize that part of what we learned when Tim was out here is that you can actually use the high frequency data to get better long run forecasts. Okay. And the empirical evidence on this and the theory behind it is all relatively new, and Tim Boleslav and his group have only recently come up with these insights and with these results. So going forward, our expectation is that yes, we will be going to higher frequency data even for our low frequency trading. It remains to be seen, however, how much value that's going to give us.
How do you assess the value?
It's very subjective assessing the value you get from a covariance matrix, from having the right covariance matrix. What we're after in a covariance matrix is we want to make sure that we're in the right ballpark. We don't care about having the right forecast of correlations to the 4th decimal place or anything like that, because we're going to hit that forecast of correlations with a very, very inaccurate forecast of expected return. So, you know, sort of like a chain where the strength of the chain is equal to the weakest link in the whole chain, and you don't need to worry about having one particular link really, really strong if you have another link that's really weak. So our objective is simply to get into the right ballpark, and we determine the right ballpark by making sure that we're not doing too much trading based on just the volatility matrix. So we'll actually look at the turnover that's caused by our volatility matrix. And if the turnover caused by our volatility matrix is too high, then we have less confidence in our portfolios and less confidence in our volatility matrix. The other thing we'll do is we'll just look at whether our volatility matrix actually is characterizing what we believe is the case in the real world. So is it the case that that our volatility matrix today is reflecting higher volatilities than it was reflecting 18 months ago? And as long as we can answer yes to questions as simple as that, then we think we're probably in the ballpark, and that's good enough for us.
Ken, do you use like other information? We talked about on Monday the possibility of using like implied vols from options and things like that as a benchmark or directly as a factor in the volatility modeling, the GARCH modeling. How do you use information like that?
The answer is yes, and it's, as I said earlier, you know, the right volatility model really depends on the specific application. And you know, we know, for example, that GARCH models in and of themselves, all they really do is they capture volatility clustering. And we recognize, as I think everybody in the industry does, that volatility does cluster. But you can do better at forecasting volatility than by only taking volatility clustering into account. There's more going on in the second moments than just volatility clustering. So to illustrate, there's a substantial literature out there that in the fixed income world that will argue that volatility should be proportional to the level of the yields or the square root of the yields or some function of the yield. That's relevant information if you're trying to model fixed income volatility. So our different asset classes do have different volatility models, but at the heart of all of them is simply capturing the time series properties of volatility clustering. Yes, we do bring other information into account in the GARCH models.
Okay, that's great. Is there any question from the class for Ken? Okay, well that's great. I really appreciate you kind of like tuning in. This is the first time we've actually done this. And we might call upon you again.
Hey, no problem at all.
Okay, thanks, Ken.
Great, talk to you later. Bye.
So Ken Kroner has actually published a lot of stuff on GARCH modeling, and he, you know, has implemented a lot of these things in terms of what Barclays Global Investors actually does. So it's kind of interesting. You kind of get what appears to be theoretical, but the direction of what is happening in asset management is real clear. I had an interesting discussion in my office with one of you the other day as to, you know, how is the industry actually evolving, and it's becoming more quantitative. You know, I've seen that. You know, I've been around for long enough that I can see that is becoming more and more quantitative. And this is just one of the tools that's extremely useful. I sent around that Excel spreadsheet. Actually, did anybody get it in their email? No, it must have been just kicked out. So it's on the iDrive, and it's a very simple spreadsheet that'll do a simple GARCH 1-1 model. And you could actually take a look at it, and you can actually say that you've estimated a GARCH model. Very useful stuff. Okay. Any other questions? Kind of where we've been? Yes.
Can you talk a little about asset positions if you're in a microcap stock, and how your one position can drive volatility, if there's any indication for asset management of making sure you don't take a position so big that you're going to actually drive volatility if you want to get out of a position?
Yeah, it's like there's 3 kind of levels of transactions costs that we can think of, and all of them are really important when you're actually tactically trading. And they're less important when you've got kind of a long horizon buy and hold. Okay? But the 3 levels of transactions costs, at least 3 levels. One of them is just the pure cost of trading, commission or whatever. Second one is bid-ask spread. And the third one is market impact. And what you're talking about is market impact. So you could have a substantial impact on a particular equity when you go in, or it doesn't have to be an equity. It can be even a liquid futures contract. If you start, even the treasury bond contract, you start putting on 5,000 contracts per leg in a trading system, that's gonna move the market. Not that much, but it will have market impact. So, yeah, that absolutely has to be figured in. That you can get in, but you could affect the prices. And if you have to unload, it's sometimes extremely difficult. So all of this needs to be figured in terms of transactions costs. And if the transactions costs are high enough, then it's unlikely that you're going to be like moving a lot on a tactical basis, because you're just going to get eaten up by the transactions costs. And I said in a previous lecture that the transactions costs are going to affect the dynamic asset allocation. Okay, because a low transaction cost asset you can easily get in and out of quickly is going to be a better candidate for tactical asset allocation. Whereas a high transaction cost asset is more of a candidate for kind of a long-term buy and hold. Okay? So, or sell and hold, whatever side of the market you're actually on. Okay? There was another question? No? Okay, well, what I want to do today is to talk about asset pricing and asset management. And what I need to do is to take you through the fairly technical lecture, and it's also the case that Monday's lecture reasonably technical. Most of the time I'm going to be just writing equations on the overhead. So that's kind of like where we're going to go today. I need you to understand basic stuff in asset pricing and how it relates to asset management. Okay? And the reason that we need to know this is that we need to be able to say something about performance. So what is good performance? So what is beating the market? Okay? The simplest way to look at performance, and maybe the most common way, is to look at some performance relative to a benchmark. So here's your benchmark. Did you beat that benchmark? And you kind of control the amount of risk, in quotations here, by looking at the tracking error. The tracking error is the standard deviation of the difference between your portfolio return and your benchmark. Okay, so it's simple calculation. Benchmark, your portfolio, take the difference, and take the standard deviation, and that's the tracking error. Indeed, you could think of setting up your optimization where we were optimizing maximize the expected return for some level of volatility. You could easily set your optimization up to maximize the excess return, excess of the benchmark, for some level of tracking error. It's just a different variance that you're using. Before, you're using the variance of the portfolio as a whole. Now you're simply using the variance of the difference between your portfolio return and whatever benchmark you're specifying. All of you should be able to change your program in assignment number 2 to actually do this. It's not that hard to do. Okay, so we're optimizing relative to a benchmark. Now, when we actually do that, we can get a frontier. Is that frontier going to be the same as the frontier that you calculated in assignment number 2? See some heads nodding. It's actually, no. It's actually going to be inside. Almost surely inside the frontier you calculated. And why? You're optimizing relative to some benchmark. Yes?
I guess the benchmark kind of imposes some constraints on when you're optimizing, essentially.
Absolutely. So it's a real constraint. And it could be a real drag on your performance. And so suppose the benchmark is an inefficient portfolio. Then you're basically optimizing relative to that benchmark. And it's going to cause a problem in terms of the portfolio that you choose relative to the unconstrained mean variance frontier. Okay, so, and you can actually do this. You would find that the benchmark is going to drive a new frontier that's inside what you actually have calculated with the standard mean variance analysis. So that sort of practice, which is very common, you know, it's very simple to say, what we're going to do, we'll have some level of tracking error relative to this benchmark, and we're going to maximize expected return, choose the weights that actually do that the best. Okay? That's almost always done in terms of this ex post optimization, like we did in assignment number 2. You know where we're headed in assignment number 3. Assignment number 3, we are forecasting the returns, or forecasting the volatilities and the correlations. Sort of optimization that we're going to do is going to rely upon the forecasts of all of these things rather than what happened in the past. Okay, so what we're doing in assignment number 3, and I believe, I forget which number of the question it is kind of a conditional mean variance optimization. Okay. And it's conditional in that everything that we're using is going to be forecasted. Okay. Now, it might be that most of our time is put into the expected returns. And it might be, given that we don't have the capability of running a multivariate GARCH model across simultaneously estimating for all 5 assets. And from that, the variance and covariance matrix falls right out. That we might make some simple approximations for the covariances or the correlations, like what we did last lecture. So use your residuals instead of the returns. Okay? And that delivers what I call the, I forget what I called it, the unconditional / conditional covariances. So you can do that. That's better than using just the unconditional. Okay. Now, before we kind of go and kind of explore asset pricing and what it actually means, and I'm going to be talking about the capital asset pricing model. I'll be talking about the Fama-French 3-factor model. And I'll be talking also about kind of multi-factor economic variable style models. And I know that you have some familiarity with probably, well, for sure, the capital asset pricing model, and maybe a little bit with the 3-factor model. So I know that, but as with a lot of things in this course, I'm going to take you on a different path to take a look at these models. But one thing I want to talk about right at the beginning that we didn't really get a chance to talk about is this idea that we're really constraining ourselves when we think that investors operate in the world of mean and variance. So in this world, the risk is the variance of the well-diversified portfolio. And I'm going to be optimizing, and I might not be using the simple optimizer that that you did in assignment number 2 and you'll do in 3 and 4, right? That's kind of like the base case. There's lots of stuff out there that kind of goes beyond that, where you use like Bayesian analysis and simulation analysis to get a better idea of the frontier. A frontier that's less, more robust, and the weights change a little less when the inputs change. And I'll talk about that in a little bit of detail, but not a lot of detail. What you've got is kind of the starting point in terms of kind of optimal portfolio control. But all of this theory, which traces back to Markowitz's work in the 1950s, all of this theory assumes that we are in a mean variance world. So I guess my opinion is that the world is more complex than mean and variance, and that variance is not necessarily a complete descriptor of risk. Okay, so let me tell you, I guess, a little bit about my research on this particular topic. I got interested in this idea of variance being an incomplete measure of risk by actually looking at the practitioner literature. What I saw in the Financial Analyst Journal, the Journal of Portfolio Management, both of these are journals that are different from the Journal of Finance in that they're more practically oriented, and a lot of the contributors are from industry. And I published in those journals. But I saw a lot of people publishing here, and then when I went out and talked to people in asset management, they're worried about things like downside risk, semi-variance, which simply means sampling the returns in a negative state and calculating the variance. And stories would be told like the following. Well, diversification only means something to me in the bad state. So if we're thinking of an international portfolio, really, I want my non-US assets to pay off when the US is down. That's what diversification means to me. What happens in the upside is not as important. So diversification is kind of like hedging. It reduces the variance. But the variance is a symmetric measure. Remember how we do variance, right? We take the deviation from the expected or the mean and square it. And it seems reasonable that a deviation from the mean that's positive, which means the actual return's higher than the mean, should be treated differently than a deviation from the mean when it's negative, which means the return's lower than you expected. But it isn't in variance. It's treated the same. So if you have a 5% positive surprise and a 5% negative surprise, they're treated identically because we square it to get the variance. Just think of how you calculate variance. You take the deviation, you square it. The square gets rid of the sign. So we have a measure of dispersion that's over kind of the good states where the return is higher than you expected, and the bad states, and it's treated identically. Yes?
Are you in any way suggesting that the risk should be measured in terms of mean utility variance, that in that respect, rather than variance in returns? That is the utility lost because of changes in returns and your future utility lost again.
What I'm doing is kind of challenging the way that we think about risk. And that's really what I'm doing. So we think of volatility as risk. And I'm just not convinced that that's a complete measure, mainly because it symmetrically treats returns. So you can be on either side of kind of the expectation, and you get treated the same because you're squaring. And the same thing for absolute value. Just take the absolute value. Okay, so you can think about it. You can think of some distribution that it's got tremendous volatility for kind of the good state, where you're bouncing all over the place, 150% up, 40% up, really wild volatility in the upstate, but really not that much volatility on the downstate. And you put all that together, it looks like big volatility. Okay, and you might say, well, I'm not interested in that particular asset because the volatility is so high. One thing we want to avoid in this course is just punching the button for volatility and saying, well, this asset's really volatile, so it should be penalized. So everybody see that? You can think of a distribution where it's got like a lot of dispersion in very good states, okay, but not that much dispersion in bad states. Yet when you press the button for variance, you're going to get a big variance. So just think of the distribution. Okay? So it's got a lot of action, a lot of tail, okay, on the right-hand side. And then on the left-hand side, it doesn't have much. So it kind of looks like that. When you take the volatility of that distribution, it looks large. Okay? And to me, that volatility is different than the identical volatility for a symmetric distribution. Okay? Okay, it's different because the volatility for the first distribution is being driven by the upside. There's a lot of upside, not much downside. Whereas a symmetric distribution with the same volatility, it's got equal upside and downside. Okay, so I treat those differently. Okay? And what is a distribution that looks like that? What's that called? Hmm? Well, that is an example, but without calling it a particular distribution. Skew. Just skew. So distribution that looks like this is positively skewed. Okay, I like positive skew. And I don't like negative skew. So negative skew is this probability of like a really serious downside. Okay, so given that I've got a preference, and I don't think I'm alone, that people have these preferences over skew. Now, if you look at the actual literature here, it's very interesting because people actually do mean variance optimization over the downstate and suggest those portfolio weights and kind of throw away the information on the upside. There's all sorts of measures of downside risk, like semi-variance, so-called Sortino ratios. There's a whole bunch of them. How do we put all of this together? Indeed, there's even a class of GARCH models that I mentioned briefly last time called the asymmetric GARCH models. Okay? And in those GARCH models, you put basically a second term. Remember, we've got the lagged volatility in the GARCH model and the lagged squared residual. What you do is you put that lagged squared residual in again with a dummy variable on it that takes on a value of 1 if the residual is negative. So if the epsilon is negative, you put it in, and basically what happens is that if it's negative, that piece gets a bigger contribution to the next period's variance. Okay, remember, we're talking epsilon and epsilon squared. So the dummy variable adds something extra to the volatility if there's a negative kind of surprise in the mean. See? Think about that. That's basically saying in the kind of down states, volatility is higher, right? In the up states, it's lower. But that just says something about the distribution. What that's just saying is that skewness is important. Okay, so I think that people have a preference for skewness. I usually use two simple examples for this. One maybe is not that great of an example, but I'll give it to you anyways. How do we explain why people pay $1 for a lottery ticket? There's lots of stuff in economics written about this. And there's also literature on, why would people, it's a similar argument about the horse track. The odds are against you, yet people are betting. And people try to tell these stories about we get some utility from actually going there and doing the bet. Well, let's focus on the lottery ticket. Okay. And actually, I do some work for, I guess, the largest lottery company in the world. And I asked them a question. What is the expected payout for all the lotteries you will run in the US? Not other countries, just the US. And they said that it was about, on a dollar ticket, 48 cents. Okay. So you pay $1, your expected payout is 48 cents. Start thinking about this. Why? If it was risk-free, and it surely isn't, then the price should be about 47 cents. And then you get the payout of 48. But people are paying $1 for an expected payout of 48. So another way to look at this, that given the traditional risk, like the variance is large, right? You have these big payoffs and a whole bunch of zeros. Right? So it's a big variance. So it looks risky, yet people are what appear to be overpaying. They're actually locking in a negative expected return. So you're paying a price of $1, it implies a very large negative expected return. Yet people buy them and buy them. Well, what's the story here? The story's simple. In this example, that you're buying positive skewness in a big way. People like positive skew, and as a result, you're willing to pay more than what you would expect if you were just in a mean and variance world. Because we know the variance of the Treasury bill over the same horizon is 0, right? We know we're going to get the payoff, $100, let's say. For the same horizon, the variance of the lottery ticket is massive. Yet you're paying way more than you would pay for the Treasury bill. So it's a preference for positive skew. So things that add positive skew, you're going to pay more for, and the expected return is going to be lower compared to what we usually think. In this case, it's dramatically lower, because you're buying positive skew. Yes?
But I thought in case of the lottery, it's really negative skew instead of that. It's kind of on the negative side, then you have.
Yeah, if you look at the distribution, actually, the distribution, there's this huge mass near 0, and then you've got this tail going out to the right for the $40 million payout. It's positive skew. So, it's a classic skew distribution. But let me give you another example. Now, I might even give you a third example that probably you won't like, but second example. Why is it the case that if you look at options on the S&P 100, the OEX, that we see a volatility smirk in the implied volatilities? So if you look at the implied volatilities out of the money for an S&P 100 put option, the implied volatility out of the money is much higher than it is near the money. And some people call this a smile or smirk. So when implied volatility is higher, what does that mean about the price? The price is higher. So it seems like the price of these way out of the money options is higher than you would expect. So what's going on there? What do these options do when you hold a put option?
Extra downside.
Yeah, it takes out the downside. And if you take out the downside, what you're doing is reducing negative skew. So reducing negative skew or buying something with positive skew is kind of the same idea. So as a result, you pay a higher price for this because you value it. Pay a higher price, and the expected return is low. This is true for a wide variety of things. And indeed, I think that it's also relevant for even equity valuation. Yes?
Do you know if that example, does that have anything to do with it happening after the '87 crash, that people just would be willing to pay for it just to avoid getting
Right.
that
So there was a lot of learning after the '87 crash because most of the portfolio insurance that was being sold by Leyland, O'Brien, and Rubenstein was kind of a dynamic futures rebalancing. Okay, so they're trying to mimic the payoff of a put option using the S&P 500 futures. Okay, so it's just a program kind of trade that they were doing purely to replicate the put option. And one of the problems that happened in October 1987 is, when the market started to fall, in order to replicate that put option, they had to start selling futures. And they put on some massive orders like the market had never seen. It didn't have anything to do with their view of the future. They were not selling those futures because they thought the market was going to go down further. They were selling purely as a result of dynamically trying to recreate a put option. And it didn't work because they had so much that they had to sell. They moved the market so, the impact was so large that the portfolio insurance wasn't that effective. If you want portfolio insurance, a put option is going to guarantee it. Okay, you've got the contract. That's it. Like, you don't have to worry about daily kind of dynamic reallocation. And I think that's true. That after '87, people learned that. And that put option is just a good example of something that reduces negative skew or adds to the overall portfolio positive skew. Okay. So there's a pattern here for these two examples. Price is high and expected return is low because you're actually buying some skew, some positive skew. I think this applies to equities also. Indeed, when you look at equities that have very high growth potential, such as some internet stocks, you could get a valuation that doesn't make any sense. Okay, and even today, right? Even though that market's come down substantially, you look at some of these valuations, they're still very high. So what's going on there? So the multiples look like they're way out of whack with the market. And to me, it's not just growth. It's kind of like the skew in the opportunities. That there's a scenario where there is a massive payoff. And that's different from other firms. It's even different from a lot of biotech. Biotech, you're working on some drugs to potentially cure a disease. Okay? You know the incidence of the disease. And you know approximately how much people would pay for your drug. Okay? You do that math, and then you figure out the probability that you're actually going to develop the drug. And there's an upside that's limited. But for some firms, like some of these so-called internet firms, you can't do that exercise. You can't cap the upside. So what do you see? You see the price go up because people are basically buying into the skew. And indeed, the price could go up so high that the expected return is negative. So you're buying something with a negative expected return. knowing that it's a negative expected return. Because there is a probability that there's going to be the big positive payoff, and you value that a lot. You like that. Yes?
I have a question. Between the two, reducing the negative skewness and increasing or keeping or buying the positive skewness, which one is more valuable?
I think it's the same thing in the end. So you know, there could be an argument that you could treat those differently, and I guess that's possible. We have to go to even more moments, like kurtosis.
Does that mean in the second example, option example,
Yeah.
so does that mean the in the money put option, the volatility of the implied volatility of in the money put option should also be higher?
No, it isn't actually, because if it's in, you know, what you're trying to do is to take out the tail of the distribution, extreme tail. That's what we're trying to do. And that's what those OEX puts actually do as a market as a whole.
I mean, in the money put option, you actually are buying the upside potential.
Yeah, that's true. Well, but they're very expensive also. But I think that's best illustrated by the tails. And that's just an example of a piece of the tail. Extreme occurrence. You're willing maybe to bear the usual volatility, but you don't like these extreme situations. And that's how it works. Okay, so what does this mean for asset management? It means that this stuff is more complicated than you learned in 350 and 351, 352. It means that that actually you're going to be confused. Well, hopefully you won't be too confused, because people are concocting all of these theories, behavioral finance theories, you know, some of which have a lot of merit, but a lot of it is just to take care of what appear to be anomalies if we're operating in a mean and variance world. Okay, so what I say to you is, well, let's expand our horizons a little bit, and let's just assume that people have a preference for skewness. You know, I think that if we did an experiment here, everybody would have a preference for skewness. It's obvious. It's actually implied by standard utility theory. The standard utility functions that we deal with have got a preference for skewness built in. But what we do is we truncate. Okay. Indeed, the CAP-M is truncated. The theory of the capital asset pricing model is much more general than just expect a return in beta. Okay. And what I've done in an article I published in the June 2000 Journal of Finance is try to push the way that we look at this a little further. Okay, so let me show you what happens to the mean variance frontier once you introduce skewness. Basically, you can kind of guess what's going to happen. Put another dimension in. So the usual frontier that we're thinking of looking at is just two-dimensional, where we've got expected return and volatility. So expected return and volatility, right? And you could think of the usual frontier as just a slice out of this surface. But there's no reason that we can't have another axis with skew on it. And the portfolios that are optimal are mean variance skewness efficient. Okay. And one thing that took me a while to figure out is, you know, the intuition in the capital asset pricing model that you go to the tangency portfolio. Well, what does that tangency portfolio look like in 3 dimensions? And it's really hard to draw. I tried to draw it, and it's not too successful. So what you do is you've got, notice the skewness is anchored at 0 in the middle. So you've got this one portfolio here, RF, that's got 0 variance and 0 skew. It's got some expected return. And then what you can think of is not just a line going out. It's kind of like a cone that's been kind of like cut. And it touches the frontier in multiple spots. There's multiple tangency portfolios when you actually do this. So each ray, you can think of each ray coming out of here will have a tangency. So instead of a tangency portfolio, there's going to be a set of tangency portfolios. Yes?
Could you describe a little bit, why is it that the mean variance for the tier has that S shape, the skewness?
The skewness, the mean variance frontier is, if we just look at every single slice, at every single level of skewness, it's got the usual shape.
Right.
Right? And the real question is, why did I put an S in there for the skewness? And for no particular reason. It was mainly just so we could see it. Okay? But there's multiple tangency points here. And then what do you do? Which portfolio is the best portfolio to invest in? Like with the CAPM, it's real clear. It's the tangency portfolio. So what portfolio would you invest in? Yes?
Well, I have a question.
Yeah, OK.
I think Brian was actually asking why, if we introduce positive skewness, then our efficiency frontier goes a little bit down, and why, if we introduce negative skewness, we have, for the same variance, we have a little bit higher expected return. Is that
So the lottery.
Is there any intuition behind that?
Think of the lottery ticket. Lottery ticket's got positive skewness. What's the expected return, higher or lower? Lower. That's why it's angling down there. So that's exactly what should happen. More positive skew, then is going to be a lower expected return. And it could be negative, right? I just haven't drawn it that way. And the more negative skew, to get people to buy negatively skewed assets, you have to increase the expected return. And that's exactly what's happening here. And I thought the question about the S was that it looks like it's kind of going down here from 0 to -1, and it really shouldn't. Okay. So I guess the idea here is when you've got assets with extreme negative skew, that you really start to ramp up. To get people to buy those, you have to offer a big premium. Okay, so this is a way of thinking about portfolio control in a world where 3 things count. Okay, so let me qualify some of this a little bit. The first thing, skewness is incredibly difficult to measure. Very difficult. I said the other day that expected returns are difficult. Volatility is easier. It's more persistent. So Ken Kroner was saying that the one thing that we really know about volatility is that it clusters. So volatility might be low for a while. It pops up and it stays up there, clusters at a high level, and then it'll come back down. And some of the econometric work is trying to better model that with different types of assumptions on the GARCH model. But volatility is pretty persistent. What about skewness? Is skewness persistent? So, for example, we could be looking at an equity return. Actually, we could be looking at a country return, like Korea, 1997, 1998. It plummets in value. So it loses 90% of its market cap, pretty well across the board. Now let's say that I go load those returns into Excel and calculate, and you can do this, there's the skewness button in Excel. Calculate the mean, which is negative, variance, which is very high. Skewness, is that going to be positive or negative? So let's say I take 5 years of data, 94 to 98. What's the distribution look like? The distribution looks like this big tail with these minus 90% realizations. And actually, if you measure it on a monthly basis, on an annualized basis, they're beyond 100% negative. Okay, so you've got tremendous negative skew in this data. Now, remember, we talked about being careful about using the past for the future. It was the main lesson between assignment number 1 or assignment number 2 and assignment number 3. Assignment number 2, we used the historical data, then we used our judgment, and we actually had an experiment with longer-term forecasts where we used the expectation. Assignment number 3, you're doing tactical sort of models, forecasting forward. Okay. So what about skewness? How comfortable would you be using, let's say, the example of Korea or some other Asian market? You observe a negative skew. You got your optimizer now set up to do 3 things: mean, variance, skew. It's got to be expected, right? We've learned that much for sure. How much information is in that negative skew for Korea? Say not much. As a matter of fact, it's unlikely to be persistent. But given the price has gone down so far, is there, given that you're down there, the probability of dropping another 90%? It seems like it's the other way around. Like after you have a large negative realization, that the expected skew is positive. Okay, so it's extremely difficult to model this, and it's not the same as with volatility, where you just put in the lag volatility and expect it to work really well. So skewness, if there's any reversal in the market, then the skewness could be negative one period, and then looking forward could be positive. It's very difficult to model. And it's also difficult to model because we're cubing things. So the residuals, instead of squaring them for volatility, we're cubing them. So any big observations are going to take a huge weight in the analysis. So skewness is something that is difficult to measure, but important. So a lot of judgment has to be used in actually doing this. Indeed, I've got some research going on that is a very simple idea. And actually, one of the webcast students asked me a related question to this. The question was, how does leverage within a firm play into risk? Okay, and we kind of know that there's a relationship between the beta of the equity and leverage. We'll use that formula, right, and valuation. And we also know there's a relationship between leverage and volatility. Okay. But let's kind of think of this a little deeper. Let's think about the equity of a firm that's levered as a call option. Indeed, the original Black-Scholes article in 1973 was called The Pricing of Options and Other Corporate Liabilities. And they actually told the story of the firm as a series of options. So it was motivated. So the equity is like a call option. The debt holders have the first priority, and what's left over goes to the equity holders. Real clear in a simple model of capital structure. The value of the debt is the strike price, and the maturity of the option is the time to maturity of the debt. So it's real simple to think of the equity as a call option. Okay? And as you increase the leverage of the firm, what happens to that call option? Does it go in the money or out of the money? More leverage pushes it more out of the money, makes it riskier. So what you could think of doing is to look at the distribution of returns that are implied by a call option. Okay, so it's a little different than what we usually think of. We usually think of looking at the distribution of some underlying asset. But if the equity is a call option, what I could do is to look at the distribution of the call option, and by changing the strike price, I could look to see how that distribution changes. Okay, so just create a call option, simulate a call option, and look at the distribution of possible returns. As I increase the strike price, the distribution changes. And one thing is real clear, it's not normal. The leverage affects the whole distribution. and the leverage affects the skewness. So leverage impacts not just volatility and beta, but also the skew. Okay, the last thing I need to talk about before we jump to kind of the mainstream asset pricing is how does this work in asset pricing? Now I said that the CAPM was a model where you basically truncate everything at the mean and variance. And you know the intuition of the capital asset pricing model says that the expected return of the security is measured by its contribution to the variance of a well-diversified portfolio. Right? That's the beta. So the beta is kind of ratio of that contribution standardized by the market variance. So contribution. So if you're adding a lot of variance to the portfolio, that means that, well, people don't like a lot of variance, so the expected return's got to be higher. If you're actually reducing the variance in the portfolio by adding this security, then beta is going to be smaller and the expected return is going to be smaller. Indeed, you know, the beta could be negative. So we could get a situation where we've got an asset that actually has got an expected rate of return that's lower than the risk-free rate. And that's fine because that asset is reducing the volatility of my portfolio. It turns out in this article in Journal of Finance, I say, well, we've known for a while that you could actually look at not just variance but skewness. So how does it work within a capital asset pricing model? Well, you've got something that's equivalent to a beta. And it's called the co-skewness. So instead of covariance, we talk about co-skewness. And an asset, the risk of the asset is measured by its contribution to the skewness of the well-diversified portfolio. Does it increase the skew? Does it decrease the skew? And you get a model that's got basically two betas. One is the beta on variance, and the other is the beta on skewness. Everything kind of follows through as you would usually think it follows through. You could use the same geometry that you used in 350, except you have to add a dimension. You know, in 350 we had the tangency, and there's a single portfolio, and then for what you wanted to invest in, there was a utility curve and kind of like touch some point. And you levered up or down the market portfolio. Well, it's basically the same idea going on here. You've got a series of tangency portfolios. You've got a utility curve with your preference for variance, your preference for skewness. And you pick off a portfolio that's optimal. So all of this follows through. Okay, so part of the story that I want to tell in asset pricing is as I said, we're going to be going through standard models. I'm going to take those models down. Okay, I'm going to show you that all these models are rejected, even though they're widely being used. Part of the missing link here, I think, is that all of these traditional models simply look at variance. Okay. The skewness model, it's going to be a while before it actually makes its way into practice because of the difficulties involved in actually estimating it. But the intuition is very solid. I guess I'm biased on this because I've got a stake in it, but it just seems so basic to me that people care about these extreme moves that it needs to work its way into the theory. Yes.
You said it'll be a while before it comes into practice. I'm wondering why you think it will become easier to measure skewness, in the future than it is today.
Yeah, well, actually, what we need is a measure of ex-ante skewness. And I've got some research going on that looks at individual firms and looks at the characteristics of the firms, okay, across a broad cross-section of firms, and tries to actually develop a model that forecasts skewness based upon the fundamentals of the firm. Like, for example, the leverage is a really important factor. I've got other research going on that actually looks at the stage of kind of the product life cycle that the firm is actually in. And it tells you a lot about opportunity. So if it's a very mature firm that has passed the hump, then there's not going to be as many of these great upside potentials, right? So just what we know from the theory of how businesses evolve can be used in actually doing it. So I'm looking at kind of long horizon modeling of cash flows, and that all feeds back into kind of an ex-ante measure of skew for a particular security fund. This can be fed into a more comprehensive asset allocation sort of outcome. And it might not be individual securities, it might be portfolios of securities grouped by their skewness characteristic. So it will be a little bit, but part of the idea of this course is to give you that glimpse. And I think that one thing that I like to use as kind of like a benchmark is whether the basic idea seems reasonable. And for this one, really does. And nobody that I know has no preference over schools and the personal investment. So where we're going to go is capital asset pricing model, the assumptions, and then I want to basically change the way you look at it. Three-factor model, add momentum, multi-factor model, APT, and then we're done for today. Okay, so let's take a 15-minute break. We have a fair bit of distance to cover. Let me just start with a question that I had at the break regarding this idea of it being difficult to get an expected measure of skew. Okay, so let me just be a little more specific about what I really meant there. And the best way to think of the distribution is just think of a histogram using the actual data. So let me go to the overhead. And let's suppose that we sample monthly returns, Korea, let's say between 1993 and 1998, maybe midway through 98. Okay, so I've got 66 monthly observations, and then what I'm going to do is a histogram, and it's going to be returns, and then basically the frequency of the returns. So that's how a histogram works. This is just the frequency. Okay, and I just fill in the boxes as to how many were in certain bins. And if I do that, what I'm going to see is this, if I smooth a line through the histogram, I'm going to see something that's got a lot of negative skew. And I'm exaggerating, of course, but it's going to look something like that. Okay, so that's kind of empirically what we see in terms of the returns. So you measure this distribution, you actually measure the skewness of this distribution. It's going to have a large negative skew, mainly because of these disastrous observations between July 97 and June 98. Okay? So that's the measured skewness, negative in this case. Now the point that I was making is that if we are sitting at the end of June 1998, that this does not necessarily represent the ex-ante or forecasted skewness for this market. Indeed, given that we've had such massive negative observations, that you might think that it's not really that feasible to go down any lower. If you look at just the value of the assets in liquidation that some of these firms have, to go much below where you were is less likely than the upside. I'm not saying it couldn't go lower. I'm just saying in probability terms, that the distribution could have looked much different. So the ex-ante distribution in terms of returns could actually be the reflection of this distribution. So it would have a big tail on the right-hand side. And this just makes it very difficult to actually measure skewness. The skewness that we measure looking at past data is not necessarily reflective of the future. Okay, so it's not, in especially the equity market, not as autoregressive. Okay, so that's important. Now let me talk about asset pricing and how this all works in terms of asset pricing theory. The first model I'll write down is the capital asset pricing model. I'm going to go through these models fairly quickly. Now, you've seen this model before, traditional model, simple model, but you know, simple enough and powerful enough to earn William Sharp the Nobel Prize in economics. Okay, so it just says that the expected return for some asset equals risk-free plus the beta of that asset times the expected return on the market. Right, you've seen this model before, simple CAPM. Okay, well let's start talking assumptions of this model. First one, what are the, actually, let me ask you what the assumptions of this model are. I know you've done it before, but it'd be interesting to see which assumptions really stuck. What are the assumptions? The usual CAPM. Yes?
The risk-free rate doesn't change.
That's a pretty heavy-duty assumption. It's constant. You notice there's no expectation on the risk-free? It's fixed. Risk-free means, like, you know for sure what the return is going to be. There's no uncertainty. Zero variance, zero correlation. That's pretty a significant assumption. What else? What about this other stuff? Yes?
Is it also applies for the beta? It's
Beta. Fixed. Okay. Yes?
Is it assume a normal distribution on the asset?
It can. Okay, so it doesn't necessarily, but one way to get the CAPM is with distributional assumptions. So basically distribution being basically mean, variance, describes everything. And when I say mean and variance, I'm also meaning covariance along with variance. Okay, and this can be got through distributional assumptions, and it could also be for utility assumptions. And very similar, that you only care about mean, you like more to less, and you like less variance. Kind of equivalent ways of getting there. One other thing that you should notice. What about those expectations? What do we call those expectations? Unconditional. So unconditional. Okay. Now, given that the model is originally posed in terms of unconditional, you can think of it exactly the sort of exercise that we did in assignment number 2. Okay? And let me just draw that. We got some assets. get an efficient frontier. We've got expected returns. We've got variance. Everything's unconditional, right? And you know how it works, right? There's a tangency portfolio. We've got RF. We've done a bit of this before. RF is going to touch the axis. And this is our optimal portfolio. Okay, now, we talked about this before in the context of our kind of asset allocation problem, where I said, well, this isn't exactly right because the risk-free does not have a zero variance, right? Well, you can also say that this isn't exactly right because I've got a zero variance. So it's not just a matter of asset allocation or mean variance optimization being problematic if we assume a zero variance for the T-bill. The model is not consistent. Okay, so if we're going to be using unconditional expectations, then the risk-free in the so-called Sharpe and Lintner formulation is not risk-free. There's no line that goes to the frontier in a tangency portfolio. None of that works. So that's the first thing you need to know. There is another formulation of the CAPM that is due to Fisher-Black. And in that formulation, he actually assumes instead of a risk-free asset, everything is in terms of an excess return over and above a zero beta asset. Okay? So we're kind of like in a situation here with a model that has got some problems. Okay? And a number of researchers pointed out that this model just didn't appear to fit that well when we actually tested. Okay. Now, let me talk about the test, and then I'm going to go back to the slide and change the model a little bit. Okay. So basically, Fama and French come along in 1992 and suggest a 3-factor model. And this is Fama-French, Journal of Finance, 1992, which is in your CD. Okay, so what they say, well, expected returns, it's a little more complicated. What we're going to do is kind of the similar RF. We're going to have a beta I representing firm I. And we'll have the market return in there also. So we've got expected return on the market. But then we're going to add some stuff. We're going to add 2 factors. Okay? And these factors are SML, HML, and SMB. Small minus big. And high minus low. Okay, what are these? These are hedge portfolios. And what you can think of doing is to sort all securities by size and sort them into deciles. So at the beginning of each year, look at the capitalization and assign stocks into a decile, hold them for a year, just redo that sort every single year. And we've got deciles. So the first decile is the very smallest firms. The 10th decile is the largest firms. Okay? Small minus big is you take the smallest deciles, 1, 2, and 3, take a long position in those, and then a short position in the large deciles, which is 8, 9, and 10. Take the difference. It's called kind of a hedged return, and it's a long and the short. And we're going to call that a factor. And that factor is going to pick up a size premium. Okay? So if expected return is related to size, this is going to do it. Okay? So it's kind of like small minus big. Okay, high minus low is in terms of book to market. So it's kind of a value factor. Again, sort by book to market. 10 deciles. And take the stocks that are the highest in terms of the book to market ratio. Again, those are the value stocks. 3 deciles, and then subtract off the lowest ones. So this is value. And you come up with a 3-factor model out of this. Okay? And let me just write out the sort of regression for the 3-factor model. And I'm going to write it in terms of excess returns. So I'm going to put an X in front of the R. So, so you can think of RIT. Let's put an X there. Just it's in excess of a treasury bill. That's going to equal alpha I plus beta I RMT. And that's also going to be an excess return. And then we're going to have another beta for SMB, so times SMB. And then a third beta, beta I HML, times HML at T, and then we've got some error. And this is the Fama-French 3-factor model. So it takes into account that the capital asset pricing model really couldn't explain the value growth stuff. And it also takes into account that the capital asset pricing model can't explain why there's such a premium for small stocks. Okay, you put it all together. And when we estimate this, what is this alpha supposed to equal? 0, right? Just like in the capital asset pricing model, if we regress excess returns on the market, the intercept should be 0. So alpha should equal 0. Okay. And they estimated this model on 25 portfolios. Anybody know what those portfolios? Did you do this paper in investments? Basically, it's the following. There are 25 portfolios sorted by size and book to market. So you think of sorting into quintiles based upon size. Again, do the same exercise that we did to form SMB, except use quintiles. Okay, so 5 groups. And then sort those again by book to market. So you get a grid of 25 portfolio returns. And when you feed those portfolio returns into this model, the alpha is pretty close to 0. And they suggest that that makes this model look pretty good. And indeed, almost everything is coming from SMB and HML. So 25 portfolios based upon size and book to market. Now, one thing, there's a number of things that struck me as potentially suspicious. And let me say I've got great respect for Fama-French. Indeed, Fama was my dissertation chairman at the University of Chicago. but a couple of things, I guess, concern me a little bit. The first thing that kind of seemed unusual was that the extra 2 factors that we're using are based on size and based on book to market. And the portfolios that we're testing this model on are sorted by size and book to market. So there's an issue of, is this the right set of portfolios to use? These portfolios are really hard to explain with the traditional models. So that's like number one thing that just kind of struck me is, and let me actually write some of these things down. Okay, the test portfolios. And the question of how robust? 2 others. Okay, that's number 1. Number 2 is kind of a fundamental thing. You know, where did these factors come from? It's like, I kind of understand where the market comes from. It comes from the capital asset pricing model. People hold a diversified portfolio. I realize that contribution to variance is important. But it's more difficult to motivate what these other 2 factors actually represent. So why is there a size premium? Why is there a value premium? So indeed, maybe you want the model to explain that, but actually what the model's doing is just putting these things in as factors. Number 3, kind of the same set of questions we had for the capital asset pricing model. Why is beta constant? Does that make a lot of sense? And number 4, why unconditional expectations? Okay, so these are kind of like 4 fundamental questions that I think that these models need to stand the test of. Let me go through each of these. Number 1, the test portfolios. Indeed, if you test portfolios that are sorted 3 ways, on size, book to market, and momentum. Everybody knows what momentum is, so if you had, like, you look at the previous year's return, let's say, and then you sort all the firms based upon that and form portfolios based upon the previous year's return. So up to very high positive to very low negative, and then hold that for a year. So if you add that other dimension, so make it a 3-way sort, the model can explain those momentum-based portfolios. It's also true the capital asset pricing model can't do it, but this model can't do it. So what's the solution to that? Add a momentum factor. Change it into a 4-factor model. But how far do we actually go in doing this? So what is the logic to having a momentum factor? What does it mean? What does the risk loading on momentum mean? Why is that a risk factor? I don't know. And this has to do with question number 2. What is the economic motivation for actually looking at these factors? You can tell a story that, HML might have something to do with distress. So if you've got a very high book-to-market ratio, it must mean that your firm's distressed. Okay? That's true in some situations. But again, how is that linked to the expected returns? Size is more difficult to explain. we notice that small firms have higher average returns, but what is the fundamental reason here? Is it because it's more difficult to transact in? The cost of transacting is higher because you get a market impact, which you mentioned. Illiquidity, somehow riskier, but you would think that we should be able to diversify some of these risks. Why is the beta constant? Well, that can be tested. You can test whether that's constant. Why unconditional expectations? Well, we can also change the model. Now, let me go back to the capital asset pricing model and show you how to change it to make it a conditional model. So go back to these notes here. To change this model to make it conditional, all I'm going to do is I'm going to put use a different color. Put some time subscripts. Make all the expectations conditional on information we know at t-1. That's zt-1, and that's zt-1. And let's make the beta changes through time also. Okay. That's a conditional version of the capital asset pricing model. It says that you expect a return next period that's simply going to be related to the expected beta and the expected market premium. Notice I don't have an expectation around the risk-free. And the reason is here, if I'm looking, let's say, 1 month ahead, the risk-free is risk-free. And that frontier, we showed the line going for the risk-free, that is a line. Because 1 month ahead, the risk-free has the 0 variance, conditional. So buy a treasury bill, conditional on the fact that I know that I'm going to get $100 for it next month, the variance is 0. So this model holds, the capital asset pricing model holds in the traditional form that you've seen it in textbooks on a conditional basis, not on an unconditional basis. And potentially you could do the same thing with the Fama-French model. And let me just show you some results. And webcast students, I did send a PDF file with these results. Hopefully you downloaded it. And also I put this on the iDrive. It's just like certain pages from articles that are already on the list. Yes, Liz?
I was wondering, on the CAPAN.
Yes.
Why here is the beta expected here?
Beta is expected.
But you just added a t.
That's right. It's changing through time. So to be a little more precise here, I could put a beta of t. This is expected, and it's based upon information at t-1. So it's the forecast. But you're exactly correct, and I was a little sloppy in my notation here. That should be the forecast of beta based upon zt-1. Somebody asked, I think after the lecture on Monday, can GARCH be used to get a beta that changes through time? Yeah. Remember, the beta is just the covariance divided by the variance, and the GARCH will deliver the covariance and the variance. Just divide the two, and you've got a beta that changes through time. Okay? So you can transform this model, and indeed, when you actually do this transformation, this model works a lot better than the unconditional version. This does a reasonable job of explaining returns changing through time. And I've tested this in a number of papers, including one paper on your list, the world price of covariance risk. This model does a reasonable job, but it's a very simple model. It just says that you need to know the beta, you need to know the market premium, and then all of a sudden you've got the expected return. So it's a one-factor model. The Fama-French model is a three-factor model. So basically, what I did was I tested the Fama-French model in the following way. I said, well, given that they're assuming the betas are constant, well, the first thing I can do is to test whether that's the case. So I estimated a model with Wayne Ferson that's published in the Journal of Finance in 1999, where I allowed the beta to change through time. And then I tested to see if the changes through time were significant. And they were. So that suggests maybe a potential improvement in the Fama-French model. But the second thing that I did suggested that an improvement would be difficult. Basically, what I did is in the Fama-French model, they test whether the intercept is equal to 0. Okay? And this intercept you can think of as the error in pricing. Okay, so we've got kind of what the model, this is the model part. The model says the expected returns this. We've got some actual returns. And on average, if this model works, the expected should equal the actual. And this we can call a pricing error. So Ferson and I have had this intuition for a long time. And basically, let me give it to you. That on average, the pricing error could be 0. But if you look at that error through time, it could be all over the place. So it could be some periods where you're really overpricing, some periods that you're really underpricing, and on average, it looks like you're at 0. So if you just look at a simple average, the average might tell you this model works really well. But if you look at the patterns through time, you might see that the model doesn't work. Now, what's even more serious is if the pricing errors are predictable. That's a sign of a really bad model. So if you run your regression model and show me, that you can predict the returns in the UK with, let's say, 3 variables, okay? And let's say you gave me the residuals from your model, okay? And those are the errors in your prediction. And let's say I took those residuals and then I ran a second regression on, let's say, the US term structure spread, which you didn't include in your model. And I get a significant coefficient, T ratio above 2, R squared. What does it say about your model? You miss something. I can forecast your mistakes, that your model's not complete. Same thing. And that's exactly what I did in this paper with Ferson. Basically said, well, let's collect all of the errors from this model. And let's see if we can forecast those errors. And let's see if the R squared is different from 0. And in their 25 portfolios, we found significant predictability in 24 of the 25. So we could forecast the mistakes their model was making in 24 of the 25 portfolios. And then we said, well, maybe because we're not giving them a fair chance because the betas are assumed to be constant. That's the original model. So let's give them a better chance by letting the betas change through time. So let the betas change through time and then redo the test. Same result. So having the betas change through time didn't buy much. Pricing errors are predictable. So, yes?
Maybe I don't understand what you mean, but when you're saying about taking the errors and trying to predict them, isn't that what we're doing when we're trying to predict the variance?
No. What we're doing for variance is trying to predict the square.
Okay.
Right? It's
Okay.
a big, big difference. Okay, so basically we're The Fama-French three-factor model is kind of a benchmark model. It's a de facto standard model in asset pricing right now. Okay? Go to, actually in the library we just gained the Ibbotson Cost of Capital book for not that big of a book, $600 worth of a book. And in that book you see various different methods to get the expected return. Fama-French, foreign funds. And it's kind of the de facto standard model. But this model, at least from my research, is strongly rejected in the data. If I can forecast the errors in the model is missing something. And indeed, Fama-French know that, because they know they've just got a model. They're trying to approximate reality, and people are going to pick at that model. And then there's a model that augments it with momentum and things like that. Indeed, we could do the same test that I executed on the four-factor model. My guess is you get the same result. Yes?
How did you know what independent variable to use, variables to use to forecast the errors?
Yeah, that's a good point.
And then once you identified something that you use forecast the errors, if you included those now into the model itself as predictor variables or additional factors in the model, would that take care of that problem?
Well, we got to be real careful here because, and this is one of the things that we need to leave the room today with an understanding. What we're doing in asset pricing and risk analysis is different than what we're doing in assignment number 3, which is a pure prediction exercise. Okay? Think of the way that you estimate a beta in simple analysis that you would use the beta for the capital asset pricing model. Look at the return on the security at time t and regress it against the market at time t. And we know that a lot of securities move at the market, and we're looking at the beta as the sensitivity of that security to a movement in the market. Time t against time t. The R squared could be like 95%. The R squared of the Fama-French model is between 92 and 98%. It's explaining what's going on. Okay? So what I call, these are sometimes called linear factor models, are used to estimate the risk, the betas. So we'd have a beta against the market, we'd have a beta against HML, a beta against SMB, a beta against momentum. So you just estimate betas with that model. What you're doing in assignment number 3 is purely a predictive exercise. There's no asset pricing content to what you're actually doing. Okay, we're going to say, and it's really important here to distinguish the difference. I don't want to see any models with the 95% R squared in assignment number 3. And indeed, if I see them, I know that you misaligned the data. Okay? R squareds are very low in predictability. This is the difference between predicting and explaining. So we account for what happened ex post in this security by what happened in the market and some other factors. Okay? So there's predictability, and I want to draw the line here between predictability and explaining. That's real important. Nevertheless, if you're trying to explain, okay, and you've got these errors, they shouldn't be predictable. Does that make sense? You're trying to explain, you've got this big R squared, right? But if I can explain some of that error, even though it's not that much of an error, if I can explain that, then something's missing from my model. So in asset pricing, everything is time t against time t. And that's also the same in just general risk analysis. You ask the question, well, what happens if this variable changes by 10%? What's going to happen to my portfolio? You don't ask the question, what happens if it changes by 10%? What's going to happen the next period is more simultaneously. Okay. So the risk models tell us our sensitivity to certain factors contemporaneously. The prediction models are something different. The prediction models are a tool to get the expectations. Now, the most confusing thing in this course, and I returned to this many, many times, is that I just wrote a capital asset pricing model up there with conditional expectations. But notice everything now is at a consistent time, t-1. All my information is at t-1. Okay, so the capital asset pricing model explains returns, and it also explains the relationship between forecasted returns in one asset versus another asset. So it's a very general model. Okay, so what are we going to do with all of this? I didn't actually answer your question, and let me just answer it quickly. One thing that we did just to start things off in our paper was the following. I know it's going to be hard to see. Actually, let me try to zoom on this. It doesn't help that much. Okay, cool. Webcast students, this is hopefully something that you printed out. Just take a look at just one of these regressions here. And this is just pure predictability of the portfolios that Fama-French are looking at. Small one and book to market one. And the variables I chose here are the same variables that we had chosen in some paper in 1991. There's no extra variables, just something we published many years ago on new portfolios. And we noticed that there was a fair bit of predictability here. The R-squared was 15% for this particular portfolio. Okay? And the question is whether this asset pricing model is going to be able to capture that as well as kind of explaining the returns. And the answer is no. So all we did is use these same variables to see if they predict the residuals from the asset pricing model. Okay, so you've got a model. You look at basically the way to do it. So you estimate that model with the 3 factors in it. You take the residuals and then add in the intercept, which is the same across every single observation, and then regress it on the lag values of these variables. These variables are basically the change in 3-month T-bill yield, the dividend yield, the BAA minus AAA yield spread, and the 10-year bond yield minus the 3-month yield, and this is just the short-term interest rate, 30-day rate. And it comes in with a 15% R-squared. You'll see these variables used in my research a lot. I tend to use the same set so that people cannot continually accuse me of data snooping. They could have accused me in 1989, okay? But in 2001, it's basically the same variables. And also, these are kind of like benchmark explanatory variables for you. Put those on the iDrive. You know, these are the sort of things where your model is going to be benchmarked against. Okay? So given that there's predictability in the returns, we felt a reasonable test would be to look at the residuals, see if they're predictable. Okay, now I'm going to kind of go in a slightly different but related direction. There's another class of models that doesn't look like the Fama-French model at all. They're based upon economic variables. And I've done some research on this also. So instead of using HML and SMD, we use variables that we think are kind of fundamentally oriented. Like, for example, the change in industrial production. So the economic activity in the economy. So what is the sensitivity of the stock to the change in industrial activity? Or change in inflation, or unexpected inflation. So how is the security going to move if there's a surprise in inflation? So things like that. You specify a set of economic variables that are related to explaining returns. Okay, and you can have a model that's got betas on each of those. and you can look to see, again, you do the same test, whether those errors are predictable, whether on average the errors are 0. And so there's a whole class of multi-beta formulations. Now, I've got to admit that I prefer that type of specification because I can kind of tell an economic story. Now, okay, well, this security is sensitive to inflation. There's a good reason for it. Or maybe we put oil in there, you know, as a fundamental input, a commodity input. And I can tell that there's certain industries that are going to be really influenced by the price of oil. Right? So there's a beta, there's a sensitivity. So these are also popular models. And it turns out that basically what we've got here is a situation where we've got like many different competing models. And you need to be aware of basically all of them. My personal preference is a model with economic variance because you can tell the story. Indeed, let me show you I just got some street research, which is kind of interesting. This is from Solomon Smith Barney, and the author is Lila Heckman, who is very high quality in terms of her research. And basically what she does, and I'll hand this out, actually I got the handout, I forgot to bring it. And it's also on the iDrive, the PDF of this. Basically what she does is look at some macroeconomic factors and to see how they affect sector returns. Again, it's going to be a little difficult to see. I'll try to zoom it up a bit. So, okay, so these are US industry returns, and we're going to regress on the change in the oil futures price. And that's a macroeconomic factor. And actually, there's 3 regressions here. This is the first couple of columns are the contemporaneous regression. So it's time t against time t, the classic risk regression. So the coefficients are betas. Okay? And then it's kind of interesting that the next 2 columns are predictability. So just kind of mix the 2 things, predictability over the next month and the next quarter. And I thought it was very interesting to do it this way. So this is a macroeconomic factor. And we could take a look at, she only reports the ones that are significant. Look at this, kind of interesting. The strongest explanatory ability for the change in the oil price is for, right at the bottom here, oil and gas. Right? T ratio of 5.9. And a beta that's positive, that's good news. If the price goes up, notice all these other betas are negative. Right? It's bad news if the price goes up in most of these other industries. Okay. Now, notice what happens if you go in terms of the predictability regression for oil and gas. Very interesting. There's nothing. So the lag change in the price of oil doesn't affect next month's return for oil and gas companies. Which makes sense. It's all incorporated into the price. It's obvious that an oil and gas company is going to be affected by the price of oil. So you figure that out immediately. And there's no predictability that's left over, either over the next month or the next quarter. Indeed, it's kind of odd here that the coefficient is negative if you measure it over a quarter. It's not significant, but it's negative. Okay? And you kind of see some other significant coefficients here. This one's obvious also. Leisure and recreation. It's got a strong negative coefficient between the price of oil and the contemporaneous returns. Right? And here, this is the case that when that price goes up, travel costs increase, and it's often associated with bad economic times. Okay, so that kind of makes sense. Now, if you look at the predictability regression, which is, we're thinking about this for assignment number 3, there are some of these industries are significantly predicted with the lag price of oil change. And some of them make sense, and some of them don't make sense. So it seems like for leisure and recreation, it seems like there's a lagged effect there, even going out to 1 quarter. So it seems like you could predict that sector with lagged oil prices. But internet? What's the relation between the internet companies and the lagged price of oil? I don't think there's any. And actually, she points out in this research that it is almost surely just a result of the data sample. Everything here is from 1989 to 2001, except for the internet sector, which is 1996. So it's probably just a short sample is causing this. But this is an example. This is kind of what I call the linear factor regression, okay, where you're explaining returns. And it's also possible that some of this stuff predicts returns. They're different questions. Okay? What we try to do here is to develop a model that relates the betas. So these are the traditional betas. The betas to expected returns. So all asset pricing models basically say the more risky, the higher the beta, then the higher the expected return. Okay? You might have to, and for oil, actually, you want to look at oil price. You want to flip the sign on it. And this is a purely predictive regression. And the asset pricing model there tells us something about why the predictions are different across different sectors or different countries. Okay, actually, she looks at a number of different macroeconomic factors. And let me just put a couple of them up. Some of them are not as macroeconomic. But inflation is here. And let me, again, just point out a few of them. In terms of the contemporaneous, there's very few that are significant. Again, internet is the most significant, and it really means nothing. You have to be careful here, because I can't see the relationship between inflation and internet. Media companies comes in negative. There's also significant predictability in the internet based upon the lag inflation. Again, I don't think that it's that big of a deal. But if we go to something that's maybe a more direct proxy for expected inflation, if we look at interest rates, you get some relations here that make sense, and again, some of them that don't make that much sense. So this is this is a 6-month change in the short-term interest rate. Okay, and again, you're just measuring betas in the first column and then predictability in the next column. And there's even a regression that looks at industrial production. And again, very few are significant. Retail comes in with a very significant coefficient, suggesting that that is important. Okay, so this is just an example of kind of like a risk analysis that's kind of mixed with expected returns. So what do we do in a practical sense with this sort of question?
Sorry, it's a quick question. When you're looking at these variables and how they help you predict the future returns, as markets become more efficient and everyone's looking at these predictors, will their predictability diminish? And then do you have to update that in the future to compensate for that?
Yeah. Okay, so let's, this is a question that I will address many times in the course, and I've already addressed it somewhat. So let me run that again. So remember, we need to separate the risk from the predictability. Okay, so the pure risk analysis is looking at explaining the return. So what causes the return to move? So if inflation pops by, it goes from like 3% to 5% annualized basis, what is likely to happen with these sector returns, these country returns, these stock returns? And so that's what that type of analysis actually delivers for you. Okay? Now, how can I make that predictive? So let's say I've got a model. I've got a linear factor model. It's modeling sector returns or stock returns as a function of many different factors. So I've got inflation in there, industrial production, change in the price of oil, you know, stuff like that is in the model. Maybe it's got like 7 variables, all contemporaneous. How do I make that predictive? How can I move forward and use that as a predictive model? Remember what we're doing. We're explaining the return at month t with the set of variables that are observed at month t.
Just use t minus 1 or t minus x.
Yeah, we could do that, but I want to keep the structure of the model the same. So I want to keep those betas. I like the fact that it explains 95% of the ex post returns. It's pretty impressive. So how can I use that for prediction? Basically, the problem is that your right-hand side variables are observed at time t. So what people sometimes do is say, well, suppose that I just put my forecasts of the factors into the model. Then I'll get an expected return, predicted return. Okay, so you've got, here's a structure that delivers 95% of the variation. And then you sit down, and often this is where some of these macro bets take place. And you know, given my quantitative model, given what you know, my experts are telling me, I really think that inflation is going to increase by more than what's expected. I'm going to take a macro bet on inflation. How do I implement that? And there's billions of dollars being run just like that in macro hedge funds, and you know, just people will take a view on something happening. So how do you implement that view that I really believe, given my information, that the market is wrong in terms of the inflation expectations? So what do I do to capitalize upon that strategy? How do I form a portfolio? And the risk model is exactly what you would use. I need to know the sensitivity of all of the individual securities and asset classes to inflation. I need to know it. And then I can form a portfolio of those securities that are the most sensitive to that particular factor. Okay, and inflation's bad news, right? So the ones that are very sensitive are the ones that I'm going to short. And the ones that have the reverse loading, those are the ones I'm going to buy long. Or like you can take the ones that have zero sensitivity. So use the risk model. It tells us something about what the expected return is. That's true. But we can actually use the risk model in kind of a dynamic strategy that takes a view. And we need to know the sensitivity to these factors. Okay, so the asset pricing theory, it delivers at least 2 things. First thing, it tells us something about the expected return for an asset given its risk. Okay? And the risk is measured by the beta. Sometimes I'll call those betas loadings. The same thing. Coefficients, whatever. Everything is contemporaneous, time t versus time t. The asset pricing model can also be used in sort of a macro way as a way to implement a strategy where one is tilting or taking a view on a certain factor realization. The example I gave was inflation. You know, it might be an exchange rate that you've got in there too. And you've got a view of what's going to happen to the exchange rate that you want to actually carry out that view, implement that view in terms of the equity trading. And again, you need to know the risk sensitivities. That's the second use. The third, more traditional use is that you form a portfolio and you just need to do some risk analysis of that portfolio. So you got a portfolio, you know kind of where it is on the mean variance frontier ex post. But that portfolio, it would be useful to know what its sensitivity to inflation is, what its sensitivity to industrial production, sensitivity to the price of oil, all this stuff. And you can use the asset pricing model to get those sensitivities. There's 3 kind of tangible uses. The problem here, and it's going to be a common theme in the course, is you've got all these competing models. What's the right model? Okay? And to be a true risk loading or beta, it must be the case that stocks with different betas have different expected returns. Does that make sense? So it's got to tell us something about what's going to happen in terms of the expectations. There's a fourth thing. Okay? And the fourth thing, I got 20 seconds for. But actually, just to tell you, the fourth thing is what we're going to do next lecture. And the fourth thing is, can we kind of come into the situation thinking rather agnostically? But one thing we know for sure is that people don't really know what to do in terms of asset pricing. So we have two possibilities. One possibility, let's just do what we're doing in assignment 3, forecast return, forget the asset pricing theory, and let's get the best possible expected return for some level of variance. Just wash our hands of the whole thing. The other thing that we can do, which might be kind of interesting, kind of formulate one of these asset pricing models that's got the usual stuff in it, the macro factors. And then we actually take a look at the pricing errors. Okay? There's a pricing error that's realized on January 31st, 2001. So basically, think of it this way, that in a simple model where there's only one factor, the market return, and the beta is 1. Okay? Very simple model. And the market goes up by 10%. The beta of my company is 1. Okay? And its excess return, measured over and above the T-bill, goes up by 5%. So beta's 1, market up by 10, but my security in January only went up by 5. So there's some possibilities here. I know the sensitivity, maybe I'm pretty sure that the beta really is 1. It's very precisely measured. So is there a possibility that this stock is just not adjusting to the information? So the pricing error, when we look at that, is the difference between what's expected, or the actual, which is 5%, and what was expected, which was 10. Beta is 1. So is there information in that pricing error that I could use to formulate a trading strategy? And indeed, maybe that's the way that we should be judging these asset pricing models, because each of these models produces a different pricing error. So can we capture the information in the pricing errors to make some money? And that's what we're going to explore. I call it alpha strategies. We'll be thinking in terms of alpha and thinking in terms of dynamic strategies, basically. Okay, so the other thing, we've got a case coming up. I've got hard copies of the case, so you don't have to actually print it out. It'll be outside my office. And I'm going to be emailing you, each of the groups, an assignment. You're going to represent one particular group in this case. Okay? So each group has got an assignment, so you should expect that. And the hard copies are outside my office. And also hard copy of the solvent.